All right, guys, you made it to another episode with It's My Money with Patrina Dixon, or if you're listening on any of the podcast platforms, The Money Exchange. I'm so excited about today's show. But before I jump in with my guest, remember that I am Patrina Dixon, your personal finance coach and international best-selling author. I teach people how to live their best lives by managing their money. And then if they want to make more money, I teach them how to be the best affiliate marketer. So if you listen for the very first time, make sure you subscribe or drop down and click one of those links. If you're one of the It's My Money Squad, that's the name of my group. I love that you are always tuning in, and I appreciate you. This is going to be a good one, so make sure you tune in. And with that, I have Tonio. What's up, Tonio?
How you doing, Patrina?
I'm so excited. We met at Ford for the Culture, right?
Yes, ma'am, we did.
Yeah, so I'm excited. So yes, for the culture. And you are, when I saw what you did, I'm like, I have to have this young man on the show. So, I want to jump right in because, people know me. And those of you that don't know me, It's My Money across all social platforms. This is all about Tonio. So Tonio, tell them what you do. I want to make sure they completely understand this. So just jump right in, my friend.
Okay, so I am the founder of Incisive Investments, which is a multi-asset private equity firm in Dallas, Texas. Essentially, what we do is we help high net worth individuals, working class professionals, and limited partners, which are large institutions, essentially make a return on their capital over a prolonged period of time. It's essentially a hedge fund approach, but not exactly the same. So there's less risk associated with the investments that they make. We dwell in both the real estate space, the venture capital space, as well as the global markets. So we try to make sure that we allocate capital in each of those different avenues in order to offset the risk that one of them could bring. In regards to the return, the industry average is a 20% return on investment over the course of 5 years. So for instance, if we had a limited partner that wanted to come in and invest $50 million because they saw an opportunity in one of the private investments that we were offered, then essentially what we would do is we would take the $50 million, we offer them the 20% annualized return. So each year they would earn $10 million return on their $50 million that they initially gave us. And at the end of the maturity date, so the conclusion of the contract that we have between ourselves and the limited partners, they would get their original $50 million back, as well as the $10 million that they have been getting annually prior to that.
So Tonio, wait, let me stop because first of all, I'm like, okay, wait, sign me up. First of all, I want to make sure because this is an episode that people are really going to need that pad and pencil to write it down. So first of all, I want to make sure those of you that are listening, this is for you, right? Everything that he said at the beginning, he said high income earners, but he also broke down some other earners. So you may not, I don't want you to get it turned off. Well, I'm not a high income earner, and because it's for other people as well. So that's number one. Number two is the other thing you said, Tonio, where it's like a hedge fund. So some listening may not know what that is. Can you just briefly touch on what a hedge fund is, and then how are you similar to that or not? So let them know that.
So essentially what a hedge fund is, it's very similar to what a mutual fund is or what a Roth IRA is. So, most people with their retirement, they put it into an account, and over a prolonged period of time, it gains interest. Instead of you putting it in there with the opportunity to potentially be penalized if you pull it out earlier, you will put your money into this fund for, let's just say, 1 to 5 years versus 30 years. They would have an aggressive approach, and essentially they would generate better returns than what the average fund would be able to do for you. A hedge fund uses an approach where they capitalize on both the upside and the downside of both the stock market or whatever industry that they are in. So whether that be real estate, so they bought a bunch of residential real estate and a bunch of commercial real estate, but the commercial real estate is not performing due to everything being online now, they would be capitalizing off of the residual income that they're making from the residential real estate, and then they would just sell off the commercial real estate to another firm.
Got it. And, before we go any further, tell me Why this? Like, of all the things you can do, how did you gravitate to what you're doing? Because I'm completely amazed by it, and we're going to get a little bit deeper into it. But people who Tonio is, as you told them about what your business does, and you want to make sure you say the name of your business. But who is Tonio? Why did you choose that? And then let's go a little bit deeper into how people can get into what you do. So, who's Tonio?
Okay, so I'll give you a background. I'm from Memphis, Tennessee. I studied at the University of Tennessee, Knoxville, and once I graduated, I went into corporate fashion, completely different avenue of business there. I decided that I wanted to transition into finance because my parents, my grandparents, all of my family members were entrepreneurs. And I've always wondered why it's so hard for a man of color or a woman of color to gain funding for their business. And why is it that they don't know the necessary steps to be able to do so? So while I was in undergrad, I traded stocks. Well, I invested in stocks. I asked my finance teacher, okay, I have this investment. I'm not sure whether or not it's something that'll be profitable, but I think it will. The company that I invested in had just recently secured a partnership with an oil and gas company, ExxonMobil. I invested, I want to say, a little over $500 into it. He asked me before he gave me the advice, was I going to sue him? Because you can't give anyone unsolicited financial advice. I told him I would not. He told me, okay, just think about it as if you're about to buy 2 pairs of shoes. Considering inflation, shoes are extremely high. After, I want to say, a month, I looked back at the $500, and the $500 was then $3,000. So I was like, wow, wait. People actually put money into stocks for a prolonged period of time, expecting a return similar to this. However, sometimes they achieve it depending on the stock. Sometimes they don't, because they don't know how to pick stocks. So while I was working in corporate fashion, I was managing some of my counterparts' money. I was trading it for them because they wanted me to essentially increase the bonus that we got, to sign on bonuses, increase the quarterly bonuses that we got, something of that nature. And I started to realize that due to inflation, a lot of people are making less money than what the industry average is actually supposed to be at this time. And so I decided, okay, I know how to do this. How can I incorporate other avenues into this? So my business partner, her mentor, is someone that works in the state government within the state of our incorporation. I can't necessarily disclose who it is because we're under NDA. Yeah. However, we get first come, first serve on all of their excess real estate that they either bought a bunch of that they no longer need, or that they need to get rid of due to bringing in more capital for the state government. So they reach out to us and they let us know that they have this land for sale. And whereas an acre of land is $14,000 in the state of Tennessee, that's the average price, we would get it for $8,000. So you're getting it way, way cheaper than what the average people would get it for. And so I thought about it in the capacity of, what if I can bring in people that look like me, that don't know what private equity is, and that always miss out on these opportunities to be able to build generational wealth for themselves and be able to say, I invested in this before anyone ever knew that it even existed, or this is how I generated income that was able to propel me and my kids' future for years to come.
And so let me ask you a question there. So this $14,000 piece of land you can get for $8,000. Does your client get it for $8,000? Is that how you bring the two together?
So essentially what happens is, the way for us to be able to purchase or go in on any of the private investment deals that we have, we essentially have to put upfront capital into whatever the deal is. So if the deal consists of, let's just say the land was $8,000, we will bring $4,000 of our own capital, and then we would raise $4,000 from the other investors, and then we'll offer them a percentage of return every year, or until we feel like we would either sell the land or we would utilize it for something else. So at that point, now the investors are making residual income off of us raising capital from them. So it's essentially like we're borrowing the money to solidify the deal. We utilize whatever the asset is to generate more income or to sell it for more capital. And then we pay the investors back their original return on investment, the agreed upon return on investment, and their original investment that they poured into us.
But okay, understood. So now the investor, right? You already have their money. You're not going to them every time you get a deal, or not. How does that work? So is it that this opportunity came about, your business is 8,000 is the opportunity. You all are putting in 4. Do you then go out to your universe of investors to say, okay, do you want to be a part of this? Or do you already have money of theirs and you know the type of investments they want and you just go for it? How does talk through that part?
Okay, so essentially I'll use a larger example because it'll be easier to explain.
Okay.
Okay, so for instance, let's just say right now we're currently looking at a deal of a company that brings in, well, last year they generated $23 million. I'll take the idea to the investors, letting them know the opportunity of scale, what the financial projections are for the years to come, research on the market, and essentially if they like the deal, let's just say they give me $50 million. The $50 million, as long as 51% of that capital goes towards that initial deal, I can use the remainder for whatever to generate whatever income that is. I bring them under contract as private investors under my business, not within whatever the deal is, because the deal is primarily between myself and the people that are selling it to me. And essentially what happens is we have the larger investors for deals that consist of multi-million-dollar returns. And then we have the smaller investors that we go to, such as friends, family, counterparts, so people within Forbes the Culture, people within whatever my networks are, my business partners' networks are. And we'll let them know, okay, we have this opportunity. If you give us $5,000, this $5,000 will generate $5,000. So you will receive a 100% return on investment. So the less money you invest, the more you would get back. The more money you invest, the lower the percentage, but still the more money you would get back. So that way everyone's benefiting.
So does thank you for breaking that down. And does like, is there an application process for somebody to be a part of the universe of people you reach out to? Or like, is there, like, you have to have this much liquid, like what, is there something like that a person would be on your list of outreach, if you will?
Okay, so we make them fill out a private investment, an investor interest agreement. We essentially ask them, we make them fill out all of their information, so name, date of birth, address, all of those things, so we can keep their information on file. We ask them how much they're interested in investing. Of course, we have a minimum amount, but sometimes people put an amount lower than that. So it allows us to signify, okay, this person would only be able to invest in opportunities such as this one. And then we'll reach out to them, we'll talk to them over the phone, we'll gather their information privately with their consent, of course, and ask them essentially what their net worth is, what their liquid cash savings are, what their tangible assets are, blase, and how we can move forward and whether or not this will be an investment that's suitable for them or not.
Got it. And okay, great. I love this so much. I couldn't wait to have you on the show. So, okay, so now let's talk about the people, right? And what I mean by the people, because your first, the way you introed is high income earners, but then you went down a little bit. So who is this not for? Like, can you talk a little bit about that? Or is there an opportunity for just about anyone? I mean, it's okay if it's not, but talk about who it's not. Who it's not for. I think that's maybe a smaller universe than what it is for.
Okay, so I'll give you some background on that. So earlier when I was starting, before it got to the point that it is now, essentially everyone that I was reaching out to would give me $500, $1,000, something of that nature. And something that I realized is, for the everyday person, they expect faster returns because in previous generations, they were taught save, and they're afraid to take the risk. But if someone is willing to give you more capital, 9 times out of 10, they have more capital sitting around. So the capital that they're giving you, they're not necessarily worried about. So I had to come to the conclusion that for the people that would give me less money, so the everyday person, which is okay, their return period would be anywhere between a year and a half, versus the larger investors, 5 to 7 years. Yeah. It's not necessarily not for anyone because there's opportunity amongst all people. Of course, the minimum investment is 500, but with the minimum investment being 500, think about, I talk to people and I tell them to think about what you would use $500 on in everyday life that would not generate you the same return that you would get from investing with us. And then I also asked them, what is your investment goals? I've had people tell me it would be to put my daughter through college. It would be to essentially retire comfortably. It would be to pay off my house, to do this or, and I like hearing what people's reasons are, because then I can dictate, okay, this is a conservative approach that we can take. That way you're not risking your daughter's chances of going to school. That way we won't risk you being able to pay off your house. Student loan that you won't be able to pay this off. So when we speak with them, what we want them to do is we want them to think carefully about whether or not this is something they will want to do, because any investment comes with risk. But we make sure that we ensure that out of anything, even if we weren't able to return a profit on your initial money, you still get your initial money back. So
that's important to note. So just say that one more time. Even the 500 or the 5,000 or whatever the number is, say that point one more time.
So regardless of the amount of money that you give us, the 500, the 5,000, the 50,000, the 500,000, something that we try to pride ourselves on is ensuring the return on the initial capital. So we ensure through leverage. So our prime brokers, our bankers, let's just say for every $2,000 that someone gives us, our bank and our prime brokers give us 10,000. So they give us 4 times what the original investor would give us. So let's just say we lost your 2,000, we will be able to take from the 2,000 that they gave us to pay you back. So we're essentially taking the loss in the situation and not you. We want to ensure that our investors are safe at all times.
That's wonderful. Is that typical that happens? Because that seems like a big old burden on your shoulders of your company. But so is that typical to happen with businesses such as yourself?
So within our industry, it is not. You will see within a lot of documentation, people will say investment does come with substantial risk, and dilution of capital and loss of capital is a possibility, either some of capital or all of capital. And they essentially want to take no responsibility for losing your money, but they want you to invest your money with the intention of them making more money. Within our business model, what we want to do is, even if we don't make any money, our investors make money. So we have a preferential return set up in place. So our investors have to make 8% before we make any money. And we don't take any management fees out of any of the capital that we would give. So the typical fund or firm would take a 2% management fee upfront from your initial capital. And then they would take a 20 to 30% performance bonus from whatever they made on your capital. So in order to refrain from taking out management fees, we solidify what the return would be for you in the beginning, instead of just letting it flow. So that way you know exactly how much money you're getting back, you know exactly how much money you're putting at risk, and you know what the timeline is.
Well, Tonio, this is phenomenal. Like I mean, I could probably have this conversation like for a few more hours, but I especially when you're one, I love what you're doing. Number two is for you to say it's a different model than those that are out there. That is admirable, right? Because some of the reason why people don't do it is because they don't have sums of money to, put at risk, like you just described. But for you to guarantee that, like that seems hard to sustain. So, one, talk a little bit about like why the people, I think you said your brokers or your banks, why do they give you the type of return on the money that you get in for your investors? Like, is it you had to be you or your company, the people that within had to be had good credit? Like, what was it out your business model that these other entities said, well, we're going to give you this much over what you're getting in because your other, let's not say competitors, your colleagues are not doing the same and guaranteeing the way you are. So how does that happen? Because I'm sure you're in business to make money. So I know that you're doing the actions to hopefully make sure that happens, not just for your investors, but for you as well, but taking on the loss because you too can't control what would come in, like, and then having the partners to have enough to value what you're doing to give you much more over. Like, can you just talk through that? Because again, the people listening are wow, this is great. One, they're either going to be a client, right? Because they're hearing what you're doing, or two, well, I want to talk to Tonio. Maybe I want to try something like this. So talk a little bit about that part of it.
Okay, so as you mentioned earlier, it's very similar to AxeCap. I'm not sure if any of you watched the TV show Billions, but if you don't, you should go and watch it. It'll give you more insight as to how we operate, as well as how the industry operates, in more of a fun manner versus it just being strictly business. But essentially, the reason why our prime brokers and our bankers decide to give us this much money is because essentially we have a certain amount of capital. We have to prove to them that we have a certain amount of capital within the firm.
Got it. Okay.
Give us that amount.
Okay.
So from historical context, I'll give you the guy that started the first hedge fund, and then someone that'll be similar. The guy that started the first hedge fund essentially started this. He raised $100,000 from his friends and family. I salute him for that, because that was hard for me in the early stages. And then you have someone else on the other side that raised $100,000, right? The person that raised $100,000, the secondary person, essentially what they would do is they would put 80% of their money into conservative stocks that just generate, so blue chip stocks that essentially generate consistent returns, dividends into the account over a course of time. Then the 20% will be implemented into risky stocks or riskier investments. The initial guy that started the first hedge fund, he essentially did what I'm doing now. He borrowed against the 100,000. So they gave him 100% of what he initially had. So now he has 200,000. So instead of putting 80,000 into conservative stocks and 20,000 into riskier investments, he can now put 100,000 into conservative investments and then 100,000 into riskier investments. And it's generating a larger return because he's capitalizing on both the open and the downside. So for us, if I raised $50,000 from smaller investors, that's 5,000 from 10 investors. I can go to my bankers and they'll give me 200,000. So now I have 250,000. I can do a lot more with 250,000 than I can do with 50,000 alone.
Yeah, got it.
It's being strategical about the plan of how to capitalize for our investors in order for us to be able to provide them with both the guaranteed initial investment that they gave us, as well as the guaranteed return.
I love it. And so that goes back to thinking about scaling and how best, and you're right, you could do more with more money. So the ability to be able to get more than what you raise from your partners allows you to have such a guarantee. So now I have to ask the question, have you taken many losses? So I know you guarantee your customers so they don't. Have you had to, have you found maybe I should think about a little bit of a different way because I keep coming a little bit shorter than I expected. Has that happened to you?
Earlier on, yes. And
Okay.
complete transparency, I want to say the largest loss that I ever took, and to this day it still bothers me because I still get reminded of it from emails or something, was $42,000. So essentially the time came after me raising money from smaller investors for me to pay them back. And I essentially lost capital. So I had to pay them from my own pocket in order for me to be able to generate the guaranteed return. However, that's why now I have a mixture of larger investors and smaller investors, because with the smaller investors, their ROI period is shorter. And then with the larger investors, their ROI period is longer. So maturity date is 5 years from now. And if the larger investor gave me $50 million, I don't have to use the $50 million just on that one investment alone. I also have reserve capital for anything else. So as it's time for me to, let's just say, pay them back the $10 million a year, which is the 20%, I can pull some of that from the initial money that they gave me while also still capitalizing on whatever investments that I put in place. So if I lost any of the smaller investors' money, let's just say I took $1 million out of it to pay myself, I would pay them the $1 million that I was utilizing to pay myself.
Yeah.
So that way, the risk to reward approach is extremely better in the case scenario of I'm still satisfying the requirements from my larger investors while still making my smaller investors happy. Because what I never want to do is take from the everyday working class citizen to please the top 1%. I want everyone to be pleased in the situation, both the larger investor, the smaller investor, as well as my firm. So at some point, we have to make money, but I would rather be the last person to make money out of the entire ordeal.
I love this so much. And I love that you structured it where, like you said, the 500 level in the 50 million level, whatever the levels are. And the loss, although I know, I didn't realize it was the pain that, what it was for you, and that you get reminded of it. But I think it was important to share. And like I said, I didn't even know it, but your transparency and this happened, it doesn't feel good. It still doesn't feel good. I don't know how long it was ago, but that you learned from that. Like, what can I do to ensure this doesn't happen again? Because it wasn't the great experience. And I think that is a great thing with entrepreneurs that they understand, like, okay, that happened. I can't dwell on that because I still have a business to run. Let me figure out how that doesn't happen again. Or if something similar, it's a lesser amount or whatever that is. I love that you, what I love is that the cycle, you've built in the process that allows for the use. I mean, that's essentially the banks do. Right. That's why as I teach people about their money in the bank and about, let's just use CDs as an example. If you want your money before the maturity date, they'll have to give it to you, but they're going to charge you because they assumed they were going to have that money for a longer period of time. So I love it so much. So know that I have people listening to this. And I'm pointing because on YouTube or across, the world from a audio platform, you're going to have people that are high income earners, people that are not so high, people that are at the $500 level. What would you like to say to them today? Like, 'cause there's some fear in there with people wanting to do this, but at the same time, people nowadays like saying they are an investor. They're an investor in real estate. They earn six figures. These are the terms that people are gravitating to and trying to figure out in their everyday life how to make that happen for themselves and not just read about it. What would you say to them in the context of your business about how they too can be a part of what you're doing? What would you say to that person, a potential client, let's call it?
Okay, the first thing would be in regards to you becoming an investor yourself. Not necessarily in my business, but just an investor overall. Find a great mentor. That's the number one step, because there are a lot of people out here that put out fallacious content and aren't actually doing what they're doing. They're in the know, but not completely in the know. Let's just say if there are 10 steps in it, they've only learned 5 of them. So they're only able to give you 5 of them. You need someone to be able to give you all 10. The next thing would be, never force yourself into a situation that will make you uncomfortable in the short term, just because you want to see something in the long term. So for instance, if the minimum investment requirement was $1,000 and you only had $1,500 to your name, don't go and invest $1,000, because what we would never want to do, and what some funds and firms out here would never want to do, is put you in a compromising situation. And in most case scenarios, that's what makes the firms and the funds look bad, because they don't do the due diligence to ensure that they express to the investor that this is not something that is mandatory for you. And then the very last thing would be open-minded. Don't allow other people to project their fears on you. That is very, very big in the investment community. A lot of people are scared to invest in specific things due to the fact that people that they know may have lost money from an investment similar to that, or they lost money to just any form of investment overall. And that will essentially allow you to be more open-minded and more open-hearted to receiving the blessings and the gifts that both God has for you and that you may never have known that are out there. So don't miss out on your opportunity to be able to partake in things such as this due to negligence, essentially.
Tonio, you brought my favorite person in, and that's God. Thank you so much for saying that, because I think that I don't even have anything to add to what you said. That was beautifully done. I'm just gonna leave it right there. So I really have completely enjoyed you being on. I think this is something that the squad, my community is called the squad. So it's my money squad is who they are. So the squad is going to completely enjoy this because I think it is important to know that one, I say this often, is different streams of income is now required. It's not even an option. You know what I mean? It's now, and to deeply understand what you're getting into is really important. So I love how you broke that down. And I can't wait for people to hear this episode. And I want to know, because we didn't say throughout here, how do they find you? Because they're going to hear you here, and I'm going to put your information down. So make sure you drop down in the show notes, but tell them as they're listening, in case they want to just write it and not go to show notes, how can they find Tonio? Give them your last name too, because we didn't say that throughout this either.
Okay, my first and last name is Tonio, Tonio, McKinley, McKinley. You can find me on LinkedIn, my first name and my last name. My Instagram is Tonio McKinley. My business Instagram is Incisive Investments, INCISIVEINVESTMENTS. And you can find us on our website at www.incisiveinvestments.net. And if you ever have any questions, you can email me at tonio.mckinley@incisiveinvestments.net.
Thank you. And again, make sure you drop down in the show notes because all of his information will be there. This dude, you are the truth. Appreciate you coming on the squad. Thank you so much for being here. And to all of you watching, thank you for tuning in. Always checking It's My Money with Patrina Dixon. Those of you that are listening, thank you for listening to another episode of The Money Exchange. And if you haven't subscribed, either place you're listening, make sure you do that. And if you enjoy this, leave us a comment. Let us know what you think about it. And then if you want others to hear what you're hearing, because this is a great way for to begin or start or continue generational wealth, make sure you share the episode with others. I appreciate you and make it a great day.